Hey, welcome back to the channel. If you're new here, my name is Chris Hammond, where we talk about retirement issues and helping people be better prepared for their retirement. And one topic that I haven't talked about before is about Roth IRA conversions. We have talked about that, but Roth IRA conversions and the question of what if tax rates don't actually go up in the future? Okay. Now, just to kind of give you a little background on this, the typical argument for Roth IRA conversions is this: convert your IRA to a Roth IRA by claiming that IRA as income and paying tax on it, so that the funds can then be put into a Roth IRA, which will be tax free, which is good because if Congress raises taxes in the future, you will have already paid at that lower tax rate, thus keeping more of your money. That is the general argument for why do a Roth IRA conversion. Why not just keep it in the traditional IRA? And as you pull it out in retirement, just pay the tax as you go. And so the typical argument is to say, hey, just let's just prepay it because taxes will probably go up in the future. So if the question comes up, what if tax rates actually don't go up in the future? So what then? Was it worth doing the Roth IRA? Well, the typical argument, the one I just read to you, has a lot of good evidence on its back to back it up on its back that says tax rates, probably will go up. So, for instance, tax rates are now historically low. All right, we had the Tax Cuts and Jobs Act, which has lowered the tax rates. Government debt and spending are through the roof. We all know that. And so if they're through the roof, where are the additional funds going to come from to keep them afloat? And so the logical conclusion is tax rates have to go up at some point. There's also increased pressure on social programs like Social Security, Medicare, as we have an aging population and we have less workers that are working to support that population, as they are now, they have paid their taxes into Social Security and Medicare, and now they're ready to benefit from those programs. But those programs are a pay-as-you-go type of program. So when you pay your taxes and your Social Security taxes, that makes you entitled to those programs. But it wasn't like they just set this money aside saying now it's time to give it back up. I mean, they have a trust fund, but in reality, I mean, the money was spent anyway. And so when the trust fund has these non-marketable IOUs that they go to Congress and claim to get money from, well, they're having to get the money from Congress to redeem it anyway. So what that means is that while you may be entitled to those programs, the fact that more people are entitled to them means that there's going to be more pressure and spending that's going to have to be done, which is going to require funds to come from somewhere. So there's a lot of good arguments that back up, a lot of good evidence and points that back up that typical argument about taxes are probably going to go up. But what if they don't? Let's just kind of play devil's advocate and let's just say, should you do a Roth IRA conversion because, tax rates might not go up? I hope they don't go up personally. I'm not betting on it, but I hope they don't. Well, what if Congress never raises rates? Well, they don't have to do anything. First of all, by default, the tax rates are going to go up in 2026 when the Tax Cuts and Jobs Act expires. So Congress doesn't have to do anything and tax rates will go up. So unless they go out of their way to do something, taxes aren't going to stay as low as they are now. But that aside, think about this. Even if tax rates don't go up, let's think about married couples. One spouse is going to outlive the other in a married couple, unless you guys are on a plane crash. That's just kind of the facts, how it's going to be. We do talk about a lot of depressing stuff around here, so yeah, that's just kind of part of it. But married couples, one spouse is probably going to outlive the other. And when that happens, that can oftentimes cause their effective tax to go up. Here's what I mean. A married couple, they have a standard deduction of a certain amount. And when they file married, filing jointly, the standard deduction is a certain amount. It changes every year, goes up a little bit with inflation. A single person filing single has a lower standard deduction. So they can't reduce their taxable income by as much on their tax return when they file single, thus makes their taxable income higher and what they pay in tax higher. That's one thing. But that's not all. Another thing that also plays into that with going from married to being single is that the tax brackets also are affected by that. So roughly for a lot of the tax brackets, it's roughly married filing jointly has a certain amount of income you can make before going into a higher tax bracket. And roughly for most of the tax brackets, a single filing single, it's about half that. So just kind of, and I'm going to make up some numbers here. These are not numbers in the tax code, but I'm just going to throw this out. So let's just say an example just to illustrate how that might look. A married filing jointly couple, they could make 100,000 and be in whatever the tax bracket is. I'll just make up a number, a 12% tax bracket. Again, I'm aware this is not the real numbers here. I'm just using this for illustration. So let's say you have $100,000 married filing jointly, that makes them a 12% tax bracket. For a single person making 50,000 might put them into that same tax bracket, right? You get the concept. That's what goes on. Well, when you're married and you're retired and one spouse passes away, the one that remains is going to oftentimes effectively have a higher tax rate just by nature of how the tax code works. Now, you think about this when, especially with a married couple and they have saved very well, they have over $1 million in traditional IRAs, and now that one single spouse who's remaining, the survivor, they have to still take a big RMD from that traditional IRA, and that's going to boost them up into a higher tax bracket easier than it would if they were married filing jointly with a bigger standard deduction and they had more income they could make before they get into the higher brackets. So Roth IRA conversions, even if they don't raise tax rates, can sometimes they still be a good idea because in all likelihood, one spouse is going to outlive the other. And it's good that while you're married, if you can take advantage of how the tax brackets work as a married filing jointly couple, that can help minimize the taxes later on. Okay. Next point, beneficiaries. Your beneficiaries could be inheriting your IRA in their peak earning years. If a 75-year-old passes away, it's not uncommon that they may have kids that are in their mid 40s to mid 50s. These are oftentimes an individual's peak earning years. And what that also means, that's their peak tax paying years. The more you make, it's not just the more you make, the more you pay in taxes. It's the more you make, the higher percentage of your money you pay in taxes. So if they inherit a traditional IRA and they're in their peak earning years, under current IRS law, they have to take distributions from that, and they also have to fully liquidate that IRA account. In other words, claim it as income and pay tax on that income within 10 years of you passing away. Now, that means they have to accelerate that, and that means they have to take bigger withdrawals, and their income's going to have to be higher, and they're going to have to pay a higher tax bracket because we have a progressive tax system. Now, speaking of that, Roth IRAs, they give you more flexibility due to the fact that we have a progressive tax system. So forgetting your beneficiaries, let's just think about you at this point. This is all about you. A Roth IRA gives you more flexibility, and here's why. Since we have a progressive tax system, it doesn't, if everybody was paying a flat 10%, then the more money you make, the more you're going to pay in tax. That makes sense. 10% of 100,000 is greater than 10% of 50,000. But the progressive tax system works where the more you make, then the higher of a tax bracket you go into. So if you can spread out your income and manage your tax brackets and try to stay in a lower tax bracket, as opposed to pulling out a lot of money in one year and really boosting what you pay in taxes up, then long term, it can help you to pay less in taxes. So let me give you an idea. Let's say you don't do any Roth IRA conversions and you have all your money in like a traditional 401k, traditional IRA. Whenever you pull money from it, you have to claim it as income, pay taxes. And a great stereotypical example of retirement expense would be buying the RV, and you're going to go tour the West. and so you get an RV, might be $80,000, $100,000, and you pull all of that from your traditional IRA. Well, suddenly, you might not have been paying hardly any taxes in retirement at all, and suddenly, whoop, you're in you skip a couple tax bracket. You're up in a much higher tax bracket than you were the prior tax year. And so now you're paying higher percentages of that amount out. Now, compared to somebody who said, I have room in this lower tax bracket that I can claim some more income. I could do some Roth IRA conversions and then put it and have it in a Roth IRA. It's all going to be tax free at that time. And then they get to that point where they get the bug, the itch. They got to scratch the RV itch, and they're going to buy one for 80,000, 100,000. They can tap into that and not be boosted up into a higher tax bracket because the Roth IRA is tax free. Now, this is a benefit they get even if tax rates don't go up. So that's something to think about. Now, just key takeaways: Roth IRA conversions, sometimes they make sense, sometimes they don't. It really is a case-by-case basis, but they can still make sense even if tax rates don't go up in the future. And I'll encourage this in pretty much any really big thing that involves financial decisions and money involved, make sure you get an objective review of your financial situation before you do this. Okay. You want to go in with both eyes wide open to know, if I do this, I'm doing it because I'm potentially going to be saving this money down the road on less taxes. All right. You don't want to do something and think, you know what, that was a bad idea, but it's too late now because I already claimed the income. I filed my tax return. I can't undo it. I've had to pay the IRS, and that's it. We're done. You don't want that to be the situation that you're in. So highly encourage you that before you start doing anything, get an objective review of your financial situation. Even if tax rates don't go up, Roth IRA conversions might still make sense for you. And if you need some additional retirement resources, head on over to my website, retirementplanningmadeeasy.com. Download you a free copy of our essential step-by-step retirement guide, and I will email it out to you immediately. And if you need an objective look at your financial situation, you can check out my website. I have my contact information on there. Or if you download the free guide, the step-by-step retirement guide, I'll send you an email with my contact information on there. You can reach out to me. We can schedule a 15-minute phone chat, Zoom call, whatever works best for you. We can do that. Well, that is all I've got for you today. I will see you guys on the next video.